Hey, let's cover some loan basics, just a high level overview so you have a basic understanding of what's required, regardless of what kind of loan program, just what most lenders and most loan types require. So, for most loans, excluding a renovation loan, we want to make sure that the property is safe and habitable and sanitary. Can you move into it? Nobody really cares about the cosmetics of it. If the house is severely outdated, it's okay. Is it safe and habitable to move into? That's really all they're looking at. And an appraiser can flag it if there is evidence of animal feces. I've seen it where there was a really, really terrible cat piss stench and it was actually flagged on the appraisal that the flooring had to be scrubbed and cleaned of it and remedied. The appraiser had to go back out and prove it because it wasn't sanitary to live in. I know, crazy, right? So it's got to be safe and habitable. Usually from start to finish, it's about a 30-day turn time. Can we move faster? Absolutely. Can we move slower? Absolutely. Every lender is going to have their own time frame, but usually from start to finish is 30 days. If you're putting together an offer, reach out to your loan officer if you haven't worked with them before or haven't worked with them in a while, and just make sure that the time frame you're putting on the close by date is going to be acceptable. Also ask them what they should have for a loan commitment date. Some loans are much more difficult than others. And if the loan officer thinks that there's a possibility that we may not get loan approval, you're going to want a loan commitment as far out as possible to protect your buyer's escrow money deposit. So if it's somebody who's like perfect on paper, not going to be a big deal, we'll have the appraisal and underwriting approval in a week and a half, go ahead and put 15 days. But if it's something that is a little bit more treacherous to get through, have that conversation with the loan officer to make sure that you're protecting your buyer with a loan commitment date on that offer. When you are looking at the home, everything that's in the home needs to be in working order. So the hot water heater has to work, the air conditioning and heat has to work, the plumbing has to work. If the dishwasher is in the kitchen and it's not working, ask the listing agent to pull it out, remove it, put it in, say, the garage or the carport, keep it unplugged. It doesn't have to be there, but if it is not working and it's in there, depending on the loan type, it could flag it as something that has to be repaired and then subject to the appraisal value. And that means the appraiser has to go back out there and verify that it's done. So if it doesn't work, unplug it, get it removed. And utilities have to be on for all appraisals when it comes to a government loan. So an FHA, USDA, and VA loan, make sure that the water and the electricity is on. It's best practice to make sure that they're on even for inspections, but if somebody's not living there and they're intending on turning it off prior to closing, ask them to keep it on for your appraisal inspection to be complete, or otherwise it could cause a problem. So there are a few things that have to be paid in advance by the buyers. And it's really important that they know this going into the process. Don't count on your loan officer having this conversation up front. Not everybody does. They should, but they don't. So be the one that's either the second person telling them this, which is always good advice, or just make sure that they know this generally speaking. So inspections have to be paid for at the time of order directly to the home inspector. Prepare them for around $500, maybe up to $600, depending on what kind of inspections need to be done. If they're getting an additional inspection, such as like a septic tank, they're probably going to get it pumped out and cleaned if it's in good working order. So that's going to be another several $100. But just general inspections and 4-point wind mitigation should be somewhere between $500 and $600. Keep in mind, if you are working with a veteran, a WDO, termite inspection, it is required, and that's going to be probably another $150. So make sure that you do a good job of explaining that to your buyers. The next thing that's typically paid for in advance is the appraisal. Depending on the loan type and also the lender, it's probably going to be somewhere between $600 and $700. If it's less than that, it's going to be a treat. So go ahead and quote about $600 or $700 for an appraisal, and that gets paid for at the time that it's ordered, which is usually immediately upon inspections being completed. If it's a condo, we have to order a condo questionnaire. I've seen them anywhere from $250 to about $350 paid in advance, And it usually takes, for some reason, about 2 weeks for that condo questionnaire to get completed and sent over, but that has to be presented up front. And if it's a manufactured or mobile home, there is a HUD consultant that is brought in and they do a HUD certification. I use a company that costs about $450 at the time of this recording. I feel like everything's going up in price right now, so it might go up from there. So maybe just quote $500 for that, and that has to be done up front. They certify the HUD plates, they look at the tie downs, they make sure that there's skirting around the property, and a couple of other things that I don't know that I can go into too much detail because manufactured homes isn't something that I work with on a regular basis. But just know if you're working with a manufactured home, there's one additional cost up front. Know that the property has to be able to be moved into within 60 days if they're buying it to be their primary home. So if it's an investment home, this doesn't apply. But if it is going to be their primary home, make sure that if there's like some post-occupancy agreement, that it doesn't exceed 60 days from the closing date. It's a Fannie Mae, Freddie Mac rule, so it doesn't matter if it's a conventional FHA, VA purchase. If it's their primary home, they have to be able to move in within 60 days. Now, when it comes to closing cost assistance, seller concessions that are being requested of, make sure you have a conversation with the loan officer before making any assumptions about what can be put on the offer for the dollar amount. The reason being is there are different caps for different loans and also different caps for the down payment. For example, if we are working with a conventional mortgage with 3% down, we're capped at 3% from the sellers, but that amount increases if they go to 10% down payment. If you're working with an investment home purchase, the seller concessions are capped at 2%. But if you're working with an FHA buyer, you can go all the way up to 6%. So make sure you have a quick conversation with the loan officer if we're going to be asking for seller paid closing costs, what that cap, dollar amount, or percentage should be on the offer so you don't have to go back and readjust those numbers later. Ask your loan officer while you're having that conversation if there's any reason that you should put a specific escrow money deposit. Let me give you an example real quick. Down payment assistance programs don't allow you to get that EMD back. So in that case, I always recommend the lowest that you can get away with, say $1,000 or $1,500, to try to minimize how much money is coming out of pocket for our buyers that need to have down payment assistance. Now, if they're going to be putting down a huge chunk of money, they're not really getting, any kind of assistance from the sellers or from down payment assistance or anything else, and you want to show up as strong as possible, going with a little bit larger of an escrow money deposit, as long as the buyers understand that this money is on the line should they not perform. Having a little bit higher to maybe strengthen your offer, maybe bring it up to $4,000 or $5,000 is a better way. But have that conversation with the loan officer just in case it's that scenario like that example with the down payment assistance. If they were to put down $3,000 and it's a VA loan and the sellers are paying their closing costs or they're getting down payment assistance to cover that closing costs and they really don't need to have any money into it, if they have a $3,000 escrow, they don't get that money back. It will go in towards, the overall transaction, but if they didn't have to put in that $3,000, we've just kind of forced them into it. So in that case, it would have been better to put a minimal down payment, even as low as $500 if we could have gotten away with it. Make sure you know who's going to be on the mortgage and also on the deed. Let me give you an example. A lot of times we'll have a married couple, but only one party is on the loan, but both are going to take ownership. If they're both taking ownership, they both need to be on that contract. So even though you might have a pre-approval letter that lists one person's name, ask that loan officer if they're legally married. If so, and it's a primary home, you're likely going to have that spouse be on that loan. Now, there is an exception to this rule. Let's say we have somebody who's divorcing, but the divorce is not final. Because that one person is buying it as their new primary home, it might say so-and-so's name, a married man, a married woman, a married person, and not list that other person's name because they have no rights to that ownership. They have no rights to that title because they're divorcing. Now, if they are divorced, we don't have to list that they're a married person, they're no longer a married person. I have an example too where I have a married couple who's buying their primary home, and then mother-in-law is a non-occupying co-signer. So she has to sign the mortgage, but she's not on the deed. And so that means she won't be on the contract. So this part can get really tricky. Just ask for your loan officer who needs to be on the contract, who's going to be on the deed, and just be on the same page with that. And then the last thing I'd like to share with you here is about appraisals. If the appraisal comes back subject to, that means the appraised value and the acceptability of that appraisal for the loan is subject to whatever that is listed by the appraiser. It might be subject to a repair. Let's say that there's exposed wires in the bathroom. When the appraiser showed up, they were in the in the middle of changing out a light fixture, but it wasn't covered, it wasn't capped. That has to be covered and capped, or that new light fixture installed, and then that appraiser has to come back for a new trip charge, so there's a fee involved, and update that report that shows that that thing that needed to be repaired, replaced, or addressed is taken care of. The other time that this might show up is, let's say you are in contract and it's subject to a new roof. We might want to get the appraisal knocked out at the very beginning of the process, and then during the loan approval process, that roof is getting put on, we could have it subject to the new roof. Now, that appraiser does have to go and do a drive-by, update that report with the new picture showing the new roof on and maybe the permit being closed out. And everybody is happy and it's acceptable to our buyers. And then so for that additional fee, that drive-by fee, maybe $150, $175, that appraiser will update that appraisal report that is now as is. It's no longer subject to a new roof because now it's been completed. If you have any questions on this, because it can get a little bit sticky, reach out to me. I'm happy to address that specifically and directly with you, especially if you have something that you're working on. Run it by me or run it by your loan officer just to make sure you are completely clear.